Okay, I'm gonna. Today we sent out a exit the trade uh, email, and then in this video I'm gonna try to explain why. Okay, so what am I doing on YouTube? Okay, um, here's what was going on and what I was looking at. Okay, today. We talked about yesterday in our market commentary. We should be getting an uptrend, and everything was looking good in the morning time. Uh, we opened up higher. We're getting the higher high, the higher low, and then the prior day's value area was holding, and then we're still okay in our trade, and then the point of control, held. And today, what happened was, this was great. This was looking good. We had a strong open today, and we were, we needed some initiated buying to come in, and we came down and we tested yesterday's M period, and it bounced, and then yesterday's N period, and it bounced again. We were looking good. Was hoping, we're going to get some more consolidation, in an up move. And then it came down and it broke below the value area high. We're still okay. Came down here to test the VPOC, and we're still okay as long as we get the bounce here. Then it did the 80% trade, came down here, tested the value area low. And this has got to hold for us to get, another higher high, lower low. And, once it broke that, then, you got the low a day. And, and, that didn't hold. And then, we're starting to, getting into, bigger risk here. And what happened was, this is your point of control right here, and you can see here that what has happened is the point of control has migrated lower, and what that means is you went down a whole lot, and you started basing around here and building TPOs lower. This is very similar to like a moving average. If if you have a big price spike and your moving average doesn't move up to the price, that shows strength. If your moving average doesn't move up to it, its price will snap back or swing back down to the moving average. But if you have a price spike and you're moving and the price is holding, your average price moves up and it tends to support it. So this is the thing, is what I'm saying is our, we didn't get it, build value here. We just started getting a lot of anomalies, and the value of the market dropped and is now lower. I want you to know there's still a good chance that our 50 strike will hold, because, see, that's the day shift, and this is the 24-hour. And you can see the difference here is the point of control did not migrate lower on the 24-hour session. And that means traders, are getting short in the hole. So it's going to depend what the overnight does. If it can get above here, this 1895, you'd still be looking good, because you'd come up and, fill in all this trend stuff, this one time framing and stuff. So, but that's the 24. That's going to depend what the 24-hour traders are doing, and they trade a little bit different than the U.S. market. The U.S. market is the larger market, and the foreign markets basically just use our close as a reference point. Um, and so carrying on, the normal range of a normal distribution is, like on a balance day, you probably get like 10 points. On a trend day, let me see if I can show you an example here. Here you go. Here's like a pretty balanced day, good distribution. So let's take a look at it. 1970 to 92. It's about 20 points. But they usually fluctuate between, 10, 15, 20 points. And then when you get like a trend day, it's going to have a bigger range. And a lot of times that'll go to about, 30, 40 points, okay? And that's the thing is today, the the SPX, the INX was down. It was down over 50 points. That's excessive, and it closed 48 points down. So that's a lot of selling. And what happened was, when you start looking at this, is a lot of the algorithms. I mean, they were just hitting the heck out of the program trading. Here you have a sell program, and look at that nicey tick. It came down and it hits minus 1,000 like a bunch of times in the morning session, and did it again in the noon session, and same again. And this is an algorithm, and you know what that is. That's 1,000 issues on the nicey, are all getting smacked down at one time. That's a lot of sellers. That's big sellers. Selling every issue, in the nicey, and it's just, it didn't come down and just touch it. It went down there, and they just kept, selling the market, and it's, program sell, program sell, program sell, and they're just knocking the heck out of it. And all the way into the close, and more program sell, program sell. So that increased the range, and now today was Wednesday, and so we take an average, and we're going to look at, okay, we got about, on a normal distribution day, 15, 20 points. And, the S&Ps come down here and got down to 1886. And we had we sold the 1850 put. So, you're only looking at 30 points here with 2 days left, in the market. So that's the thing. The trade could still turn out good, but we're getting into an area where it would be guesswork and getting iffy because, we trended down and we're building value here. And, if we're down 20 points Thursday and Friday, our option trade would go in the money and we would lose a lot. So, what I wanted to do was get you out of there with a smaller loss to break even or a little bit of profit, that I could. It's better to just scratch the trade this week and just get another trade. I have exit criteria, and we were just getting too close to it, and it's risk was increasing too much because right now at the beginning of the year there's not really a normal market. when the S&Ps are getting smashed for 50 points, you know, that's a lot. And you know, we know who it was. You know, I mean, you know, it's not like some strange event. Uh, you know, so when you come over here to your, um, you know, commitment to traders report, which I'll say a little bit about that. You know, the way to look at this is not like, oh, it comes out on Friday and it's no good because it's late. It's, you know, trading doesn't end till Friday and they post it on the Tuesdays. But the correct way to look at this is that you know who did what last week. So you kind of know whose pocket the money's in. And some, you know, one possible reason that we have such range extension is if you look at non-commercials, you know, and a non-commercial is basically just, you know, funds. It's mutual funds, and banks trade mutual funds, and you have hedge funds and all that kind of stuff. And, you know, they just basically trade for the value of the fund. In a commercial, you know, it's a commercial enterprise. It's somebody buying or selling commodities, you know, like corn, because they got to make Kellogg's corn flakes and all that. Or, you know, or, you know, they, you know, the price of cocoa affects, you know, Hershey's bottom line. But the thing is, they have a main business. They're a commercial. They have a vested interest in, you know, another enterprise, you know, whereas a fund, you know, doesn't. It just trades for the fund, you know. And you know, the options market is a derivatives market, basically. And, you know, basically what that is, you know, a simple way to explain it is, you know, if I own the Dallas Cowboys, I have a vested interest, you know, in the Dallas Cowboys. You know, I got to pay salaries, I got to rent a stadium, and you know, I got to buy helmets and all this kind of stuff. Whereas in it, you know, if I'm just a fan in the stands and I'm betting with my buddy if the Dallas Cowboys are going to win or lose, you know, that's kind of like a derivatives market. They don't really have you know, a vested interest. It's just a bet, you know. So that would be, you know, a commercial would have a you know, a vested interest in it. And, you know, you can see here they were mostly short last week, and the non-commercials were short last week. So they're kind of on the same side of the trade, and that could be possibly one reason why we're getting such, you know, increased, you know, volatility, and the ranges are expanding, okay? So that's the deal here. We broke below our doji, you know, and we broke below yesterday's low. I mean, and it's the increased range is really bringing us close to our where we'd have to get out, which is around the 1860 area, and it's just getting too close to this range here. And you know, we don't know what the night session is going to do, and if the night session doesn't go up, you know, we can come down and hit this 60, which you know, we would get out of the trade, and then it could bounce up on Friday, and it works a lot like that, you know, because right now, you know, most traders trade, you know, what's called delta neutral, and you know, there's people in calls, you know, and you know, what they'll do is, you know, the puts are making money, the calls are losing money, and they'll run the thing up, get out of the losers to calls, and then crank it back down by selling blocks of stock. It's a different story. But that's all you need to know right there, basically, is the risk is getting too close. We're starting to increase the risk too much. So I just felt it was better, hey, let's get them out of there. Right now, you know, as close to break even as we can. And that's why, you know, we've still got a poor low here. Value of the market's coming down, and it's going to be more dependent on the overnight, which we don't know is going to happen. Hadn't happened yet. And, yeah, it was just better to scratch this trade, you know, rather than to hope and pray that it's, going to do this or that, or we're going to, hang in there. But had we got some kind of holding of yesterday or Friday's low or a value area or a point of control, we'd have hung in there, But even if the value area low, remained up in here, we'd still be okay because traders would be short in the hole, and what you get a buying frenzy, because they're getting too far out of value. But you had a really long value area today with no distribution. It's a trend day, and then but that's the thing. You're closing near the low, and you're building, value lower, so it can go even lower, and that's the reason I issued. Let's get out of there close to break even as we can, and see what we can do next week. You can't win them all, but we just got to win a lot more than we lose, and so we have to manage that risk and get out of there.